many of the things that surprised me were things that didn't happen in my lifetime, but happened before my lifetime. And that everything that it's coming to me is new, that hasn't happened into my lifetime, I have to study. And that's by studying the Great Depression, we were able to anticipate the 2008 financial crisis. So there's a mechanistic reason. There are cause-effect relationships. And three big things that are happening in our lifetime that haven't happened before, I needed to examine. And those three things, I think if we focus on them, they pretty much encompass most. Those three things are, first, an enormous amount of debt creation, which is debt that's monetized, that has to do with the value of money throughout history. It's been very much the case, in all cases throughout history, that when there's not enough money, there is then the creation of money. Rome, they had gold coins and they put other metals in it and they depreciated it and so on. So we have something that is going on with money, credit, and inflation. That's due to the fact that we don't have enough real money. Okay, that's one fact. The second is internal conflict. By measures, I like to have measures, and so there are lots of measures in this book. We have populism of the left and populism of the right that are irreconcilable differences. History shows that when the causes that people are behind are more important to them than the system is in jeopardy. And so if you look at populism, or you look at the size of the wealth gaps, or the values gaps, they're the largest since the 1930 to 45 period, and it's understandable. And the third is the great power conflict. We began our world order in 1945, and the pattern repeats all the time. There's a war. The winners of the war determine the world order, the rules of the game. That's why the United Nations is in New York and the IMF and World Bank are in Washington. And then you have the world order and the dominant power. The United States had 80% of the world's money. Money was gold. And it had half the world's economy, and it had a monopoly on military power. And as that power changes, then you have great power conflict. And so you're having these three things happen again for basically the same mechanistic reasons. And if you go back through history, you see that they repeat over. So they have this cause-effect. So I think that when we look at the future and we calculate it for just year by year, we're now in 2022. We're in the part of, they always do it the same way. You have a downturn and they print money and credit because that's the way that you stimulate the economy and so on. It produces inflation. They tighten monetary policy. There's a trade-off, and there we are. Now, then you take that forward and you look at 2022. There's a political thing going on. We're going to have midterm elections in the United States. We're going to have a change in government, the 20th People's Congress in China, and so on. There's a political thing going on. And then you take 2023 and 2024, and with this populism, you're going to have possibly irreconcilable differences. In other words, it's entirely possible that neither side accepts losing in the domestic. And so when you have that going on, you need the historical context. So mechanistically, that very much looks the same. Naturally, everyone is in a position that they needed more money. Where did they get the money from? If there was limited money, they'd have to get it from someplace else. But what they do is produce money. So central banks produce money. Where does the money come from? You could have it from taxes and take it from somewhere else. But that's difficult because people want to hold on to it and they don't want to give it up. But nobody asks, where do we get do we have enough money? But we need more money. Everybody agrees we need more money to spend. But if there was a limited amount of money, we would say, where do we get it from? And we'd have constraints. But we're not like that. So what happens is naturally you're in the positions that you need more money. And so the central banks print more money.
So the question is, will the stock market crash in 2025? The S&P 500 index is on its way to its second straight year of outsized returns in 2024, and after generating a total return of 26% in 2023, it is up by around 30% in 2024, and that has led some pundits to question whether the market is becoming too good to be true. And meanwhile, a much known investor, Warren Buffett, has clearly taken notice of some elevated valuations, selling some of his top holdings and stockpiling cash. Now, when an investor like Warren Buffett is selling his top holdings and is liquidating to cash, which means that what a normal investor like you and me would understand, that Warren Buffett is sensing that something's coming. So let's take a look at two of the main issues that will likely help determine whether the stock market could crash in 2025. The first thing is valuation. By a number of measures, the S&P 500 is clearly trading at historically high valuations. Now, the S&P 500 index is trailing at a level it has only seen 3 times since 1871. 3 times since 1871, that is a long time. And if any data suggests something like this, investors should be careful. And each time, in each one of those cases, it is followed by a bear market. The metric we are talking about here is the price to earnings ratio. The metric calculates earnings based on 10-year average adjusted for inflation. The purpose of doing this is to smooth out any economic cyclicality and earnings volatility, and the S&P's PE ratio has only hit 38 times in the past 2 other periods, during the dot-com bubble and early in 2022 before the market pulled back. The ratio was sitting at 38.8 times at the start of December. Now, while the Shiller PE ratio has predicted 2 past bear markets, it is worth pointing out that it is a very small sample size. It is also a backward-looking metric while the market tends to be forward-looking. The S&P 500 is also currently very top-heavy, with Apple, Nvidia, Microsoft representing about 20% of the index. Nvidia is at about 6.8% of the index, is particularly noteworthy as its earnings per share even 2 years ago were very different from its earnings in 2024. And meanwhile, many of the largest companies in the S&P 500 are currently enjoying substantial earnings growth, which is bringing down their future price to earnings ratios. And for example, Nvidia's trailing 12-month PE is 56, but its forward PE based on next year's analyst estimate is only 32, which should tell you something. So the thing is, with Nvidia, it seems like, at least from numbers, Nvidia already has its majority of the growth so far, and while the future for Nvidia looks terrific, it's not gonna be as good as it has been for Nvidia in the past. So while Nvidia is a great company with tremendous potential, it has also clocked on that potential. And how much more potential does Nvidia still have to achieve for someone to make a lot of money by investing in Nvidia stock today? So artificial intelligence will perhaps be the biggest determining factor whether the market continues its strong run or whether it crashes in 2025. And the Federal Reserve has also started raising interest rates to cool things off, while currently it's begun cutting interest rates. About a third of the S&P 500 is very concentrated among 8 companies that are very closely tied to artificial intelligence right now. And while the internet boom was being led by a bunch of upstart companies in many cases, the AI boom of today is being led by extremely large, highly profitable companies that in most cases have diversified businesses. And with that being said, growth from these companies is being spurred by AI, and thus AI is going to be the biggest driver of the S&P 500 in the years ahead. It starts with AI infrastructure spending. If this suddenly collapses, like what happened to Cisco during the internet boom, then the market likely will crash. However, the spending is currently being driven by very large profitable tech companies that are competing to develop the best AI models they can. As long as this competition continues, it should be good for Nvidia and by extension the S&P 500 index. And to advance AI models, companies need exponentially more and more computing power and thus greater AI infrastructural spending. And with that being said, this AI spending needs to translate into growth for the big tech companies spending this money. And thus far, the companies with big cloud computing units like Amazon, Microsoft, and Alphabet have seen strong revenue and operating income growth from their cloud computing segments. And now, their customers also need to see strong growth from AI as well. And you are just starting to see AI-related growth ramp up in the software industry. And the software companies in turn need their AI solutions to save on cost and create efficiencies for their customers, including those outside the tech industry. And right now this feels like these things are still in the early AI innings, which is why I think the market can continue its strong run and won't crash in 2025 overall. Bull markets typically last around 5.5 years, and we are only just a little more than 2 years into the current one, so yeah, we still have time. And at the end of the day, I think the performance of the S&P 500 is largely going to come down to how much companies are benefiting from AI and how much are they willing to spend to improve their AI. Eventually, the law of diminishing returns will catch up with AI and AI spending, but right now that looks far off. But some people are saying that even if there is not a market crash, there will be a market correction. The most important thing to know about a market correction is this: you won't know it is a market correction until it's officially over. A market correction can turn into a crash, but when it doesn't and it goes up, then you know, okay, this wasn't a crash, this was just a correction. A market correction is defined by a drop of less than 20% between the time when the market enters the correction territory of a more than 10% decline and when it stops failing. You won't know if it's just a correction or a more serious market crash, and it is usually defined as a rapid market drop of more than 20%, or potentially it could become a bear market, a prolonged period of market decline of more than 20%. So what causes a correction? Market corrections and crashes can be triggered by a number of things. Sometimes it is an external crisis like the pandemic in 2020, the COVID one, and other times a particular industry or economic sectors implodes and sends ripples around the entire market, as with the bursting of the dot-com bubble in 2000 or the housing crash and resulting financial crisis of 2008. And other times there is just a sense that the market is overheated, and the other times there's just a sense that the market is overheated, meaning stock valuations have gotten too high, and if big institutional investors make the determination and pull money out of the market, the resulting small drop can send retail investors into a selling panic, resulting in a self-fulfilling prophecy. And crises don't always trigger corrections though. When oil prices collapsed in 2014, the bull market continued. Investor sentiment, economic indicators, and global politics and breaking news all play a role in determining whether and when a market correction occurs or it doesn't. So the thing is, can you predict a market correction? The short answer is no, but the more complete answer is market corrections have been part of the market since its inception. Historically, the probability of experiencing a market correction within the next 10 years is 100%. So now when you know it is bound to happen at some time or the other, well, all you have to predict is when can it happen? When the stock market is too overvalued, when everything related to AI is just going sky high. Is that a time? You never know, could be. But when the stock market corrections happen, stock market corrections are a great time to buy. Far from a time to panic, market corrections usually turn into outstanding buying opportunities as they are often both brief and mild. All 28 corrections of the past 50 years have been more than completely erased by a subsequent bull market rally. And what's more, the S&P 500 has spent almost 3 times as many days of the past 50 years rallying compared to the days it spent in correction. Though there is no guarantee in the stock market, buying an index fund or a basket of high-quality stocks within a major index like the Dow Jones or the S&P 500 during a correction is about, it has to be the best long-term play you can make.